Oh, welcome back, everyone, to our last video having to do with Chapter 6. So let's dive into some other expenses that might have some unique rules have regarding their deductibility when we're coming to when we deal with a business that the taxpayer runs. So transportation and travel, of course, have to fit the category that we talked about earlier, ordinary and necessary. That means they have to be business related. They have to further the business. They cannot just be getting somewhere. So transportation is different than travel. Transportation is the expense of getting from one place to another workplace. While travel means going out away from home, usually requires an overnight stay. So that kind of a standard has got to be at least 2 hours travel time away, things like that. But it requires an overnight stay. So there's a little difference in those two situations and in how the IRS or how we should classify things. So where the controversy usually comes is local transportation costs, because commuting expenses are never deductible. So getting from your home to your place of business, if it's not in your home, okay, is not deductible. It may feel like it because the local transportation cost, but is specifically not deductible. Getting from one workplace to another is deductible. So here's the thing. Let's say that your business is located 5 miles from your house. Driving from your house to the business is not deductible. But if you leave that location and go to another location where you have business, that is deductible. Going from that business to visit clients and customers is deductible. Okay? Any business meeting away from your regular workplace. Okay, so if you are going past your workplace to any type of other location, and if your workplace is temporary, so for instance, if you were your regular place of business is 5 miles from your house, but you have a project that you go directly from your home to your client, and that you're actually working at the client for a couple of months, then that could be deductible because it's temporary. Now, some would argue that it's only the amount over what you would have spent commuting, but that's a little bit of a gray area. Okay, so where it comes powerful is if you can establish you have a home office. If you can have a home office and you have to fit the definition, then anytime you leave home to go to any other place, location for work, business, then it is deductible. All right. If it is deductible, your local transportation can be deducted at standard mileage rate. It was typically much easier to use 67 cents per mile in 2024 than the actual business auto cost, to keep track of all your receipts and what it is, figure out how much you spend on because you still have to track your miles, because you still have to divide it between your business expenses on your car and your personal expenses on your car. And if you're running your own business, Schedule C, you're going to have a vehicle that's used for both. It's going to be pretty rare that you have a vehicle 100% used in business. But if that's the case, that's socially acceptable, but it's typically rare. The slide says actual expenses usually give a larger deduction. That's probably, in my opinion, not true. It's probably, you get a larger deduction with the 67 cents a mile. But it depends on the size of the vehicle and how much good gas mileage it takes and how old and how much repairs it is going to take, that sort of thing. So now back to travel. This is going away from home, right? Out of your area or out of your normal business area. Then your travel, your meals. By the way, meals are not deductible around local transportation. You're driving from here to your client, even if the trip is deductible, and you stopping to eat on the way is not, the eating part at least. Lodging when you're out of town, incidental expenses. This shouldn't last more than 1 year. Sometimes you'll get an assignment and it'll be for out of town, and it'll be for a long time. So the theory was, well, I can deduct all my meals and lodging that whole time that I'm there. And so the IRS kind of had to say, all right, we do understand that, sometimes that happens. You get a long-term assignment, and you need to be in a place for quite a while. You need to live in a hotel and everything, and that can be very expensive for your business. But we're not. When you have an assignment that's going to last more than a year, it changes your tax home. Your new home is in that hotel, and therefore they become non-deductible. Okay. Any type of a trip, this kind of trip, you have to allocate between personal or business. The travel days, if you're traveling on that day, that counts as a business day, not doesn't have kind of a personal day. But if your days, typically based on the days you spend doing personal or business stuff. All right? So you need to be careful that you document your business activities if there is a potential that it could be looked at as something personal. Meals, business meals are typically deductible now, 50%. But entertainment is not. Going to the game is not. Taking a client out to lunch can be, but limited to 50%. Has to be directly related and associated with business, and you should keep a record of what it was the business purpose. If you really want the deduction, this is a clear place that people take advantage of and manipulate, and the IRS is not shy about auditing or checking the business meals. They are very suspicious, as they probably have reason to be. Now, if you are traveling out of town and you can document your business purpose and your time you went and came back, you can use what's called a per diem. And that works just like the mileage, where you just take 67 cents a mile. You can take so much per day for your lodging, for your meals, and you can see that it's 59 for your meals. And then there's a whole series of areas that you can look up that have higher costs that you can take a higher per diem. And that means you don't have to keep track of all your meal costs. The assumption is if you were in that area for the day, that you spent $59. So as long as you can show the IRS that you can prove that you were there and that you had a business purpose, then you don't have to prove with receipts the hotel, the standard meals, or the meals, or some incidentals like dry cleaning, stuff like that. It's just a flat amount that you get to deduct per day. All right, so a couple of things to review. Didn't mention this: when you take depreciation on a business auto and use standard mileage rate, that you can't do both. It's one or the other. You either take the actual expenses, which include depreciation for your car, for your transportation, for your business, or you take the standard mileage. Okay, transportation costs are all allowed when there's a client. No, that's one of the places, but it's not the only one. Okay, and deduction allowed for meals, lodging, and incidental expenses when traveling away from home. Yes, that's true, and it even can be used a per diem if you can document that purpose. You do not have to keep receipts on all of the expenses. $59 is the meals and incidentals. Okay, and now taking clients to a Major League Baseball game is not deductible. No longer. Doesn't matter how much business you talk at it, it's still not deductible. All right, business use at home. We mentioned a home office and the idea of a home office. This is a powerful opportunity in deduction if your business qualifies by using a place in your home exclusively for business on a regular basis and for the trade or business, not hobbies, not other things. It has to rise to the level of a business. Okay, so that is the idea. You have an area that you have designated and can show that it is what used for business. You don't necessarily have to have clients meet with you in that place, but it can help prove that it's a home office. It just has to be available and used for administrative tasks for your business. Okay. There's a whole form, 8829. The design of the 8829 form is to calculate how much of your expenses. So what you do at the top of the form is you look at the square footage you use exclusively for business, divide it by the total square footage of your house, and you take that percentage and you multiply that by all the indirect, as it says, home expenses. Direct business expenses are still 100% deductible. So if you can show that expense was just for that home office area of your home, you can get 100%. Or just as a normal business expense, like copy paper or ink toner or something like that. Those are all things that could be used exclusively in the business. And that is not an expense for the house that needs to be allocated. Now, there are some limitations. You're not going to get a loss out of a home office. Home office deduction is limited to the business income. So all your other expenses come out first. You figure out what your income is without the home office deduction. And then you can take deduction as long as it does it, you get down to zero. Any unused home office deductions gets carried forward to next year. And you deduct first on your home office the portion of your mortgage interest and real estate taxes, then other home expenses. Now, mortgage interest and real estate taxes, as we learned in Chapter 5, are deductible for Schedule A. So when you have a home office, you're taking part of it on the 8829, which goes on to the Schedule C, which is a good thing because it lowers your AMT, I mean your AGI, um, and then the other part, what is for the rest of the house, is on the Schedule A. Insurance, utilities, and depreciation on your home isn't deductible at all except for the part that's used for business. So that converts a personal expense into a business expense because you use your home office. All right, so business bad debts have a little bit of a different. This is a situation where you have sold something to a client and they have not paid you. Now, here's the thing that this situation, most businesses use a cash basis. So your small business typically is not going to record income until you receive the money. So this is only going to count if you happen to use accrual-based accounting for your small business and you record revenue when you earn it, not when you receive it. Because then if you record it as when you earn it and then they don't pay you, then you can take it off as an expense. Okay? So it's still going to be very scrutinized by the IRS. Casualty losses, we learned in Chapter 5, are very limited for personal. You got a 10% AGI floor. You have to be in a federally declared industrial area, all that kind of stuff. Business casualty losses have a lower threshold. It just needs to be something that destroys some business asset. And it still needs to be sudden and things like that, but it's not limited by the AGI floor. And it counts as a for AGI deduction, not a from AGI deduction, like the casualty losses on your personal assets. So, example, Jose uses 20% of his home exclusively for business. He had the entire exterior of the house painted and the interior of one room that he uses for office paint for $3,000 and $500 respectively. For $3,000 for the whole outside of the house, $500 for just inside of the one room. Was a deduction you can take in a home office? Well, 20% times 3,000, that's 600. Okay? That's the percentage, that's the part of the whole outside. And then the 500 that is just for that office is also deductible 100%. So 600 plus 500, 1,100 is the answer D. Which of the following comments is true regarding the home office deduction? Taxpayer must see clients at home? No, they do not. Home office deduction is limited to the income from the Schedule C. That is true. Okay. Taxpayer is allowed to take 179. No, you never take 179 on a real estate, whether it's home office or any other real estate asset. And depreciation can be allowed as a home office deduction on the part of the house that you use for business. When business property is partially destroyed by a casualty, just like a personal casualty, you're looking at the lower of the fair market value or the adjusted basis of the property. The lower the fair market value change. So the decrease in the fair market value. Okay, so it really is, that C should be a little longer. It should have that decrease in the fair market value or the adjusted basis. All right, and we kind of hinted at this in our first video on Chapter 6. Hobby losses are now no longer deductible no matter what. So if you have a hobby, okay, and it's not in it for business, meaning you just do it for pleasure, but you sell a painting, or you sell a sculpture or some woodworking project, that income from selling that is still income. You still technically, according to the IRS, according to the tax law, have to report that as income. And you don't get any expenses to offset against it. So it's important that if you can, that you do the things you need to do to make it appear and operate as a business. Okay? Education expenses. If you are you have your business and you take some classes to maintain or improve your skill, okay, it's deductible if it meets the express requirements of the law. So as a CPA, I have to take 80 hours every 2 years of continuing professional education. That meets the express requirements of the law. So that is deductible for my business. Not deductible if that meets the minimum educational requirements for employment. So if you are in a business that requires you to have a bachelor's degree and you go to school for a bachelor's degree, that is not deductible education, at least as a business expense. You got other ways to deduct education expenses that we have talked about and we'll talk about, but not as a business expense. And technically, if it qualifies the taxpayer for a new trade or business. And of course, that's a judgment call as to what qualifies as a new trade or business, or if it just adds to your current business. All right. If a taxpayer has shown a net profit for the last 3 years, activity is not considered a hobby. That is a kind of a de minimis rule, or the IRS is not going to challenge whether it's a hobby. They kind of said, if you can show that you've earned income for 3 years, we're going to stipulate that must be a business, regardless of how lame you run it or that sort of thing. And you can never take a net loss on the activity considered a hobby. That's true. There's no losses unless you can show that it is a business. On the income that you make from your business, you must pay self-employment tax. And this is the biggest shocker for a lot of self-employed people, is that this 15.3%, 12.4% for Social Security and Medicare, 2.9%, is usually much higher than what they pay for their income taxes on their employment, on their self-employment income. However, there is a limit. It does, once you get past 168,600 of self-employment income, that's the limit in 2024, then you don't have to pay that 12.4% part. And the Medicare is not limited. It goes up to as much as you earn. Now, we did talk about this back when in Chapter 3 as a deduction for AGI. Well, we didn't get into the kind of the weeds about how it's calculated, that we will in some of the examples that we're going to show you in just a minute. All right, so, and how that limit works. So, Kia had $53,000 of income from a self-employed consulting practice and had no other income during the year. Total self-employment tax, take $53,000. This is after other expenses, right? $53,000 times 0.9235, which is the basically a deduction for your half of the self-employment tax. 0.9235, and then multiply by the 15.3%. Okay, we're not close to the limit, so there's no need to consider the limit, and you'll get the answer of 74.89. Okay, number two, we assume the same facts as in one. In addition to her $53,000 self-employment income, Kia receives W-2 from her wages from her employer with $175,000 in wages. Well, that means that she's already paid past the limit, just on money she earned from her employer. So she has income from her business and income from being an employee. Therefore, we're looking at the 53,000 times the 0.9235, but we only multiply it by the 2.9% because that Medicare still applies. But we've already covered our obligation, if you will, for the Social Security portion. And then this last one, we're in between. So we've paid on 125 from our W-2. Okay? So we took the easiest way to look at this one is to look at the limit, 168.6. Subtract the 125. Okay? And take that number. Well, we got to get multiply by the. Let's just make sure that our 53,000 times 0.9235 is more than the limit, and it is. Once you multiply that by that, okay. So up to the limit of 168.6 is you take that number, 168.6 times minus 125. And we multiply that by the 15.3%. And then 53,000 times 0.9325. Okay. The part that is over 168.6 you only pay 2.9%. Those two calculations together add up to 68.25. And then the last one is a qualified business deduction. If you have a small business as Schedule C, after you subtracted all your other expenses, there's another expense, another deduction you get. There's 20% of your income, or 20% of your taxable income, whichever is less. Okay? So you have this kind of convoluted calculation after, okay, you've got all the other expenses, and after you have all your other from AGI deductions, because you got to have both numbers to know what the QBI is. And then that applies to anybody with income under 364, 200, married, and 182, 100 on others. If you're over that, then you can have limitations on whether or not you get the 20%. The only way you're going to get the full amount is if you pay your employees a substantial amount of W-2 income, or you have a substantial amount of assets in the business. Okay? So you've got to watch that limit.